Ever looked at a giant company's financials and wondered what's really going on behind those big numbers? It's not just the final figures, is it? There's a whole structure underneath, kind of like plumbing. And well, if that plumbing's leaky, how much trust can you really put in what you see? Today, we're doing a deep dive into something absolutely critical, but often kind of murky: integrated audit procedures. Think of this as your inside track. We'll help you understand how auditors make sure it's not just the numbers, but the systems creating those numbers that are solid. We're going to break it all down, even the tricky bits, make it super clear. Let's jump in. Okay, first things first. What exactly is an integrated audit? It sounds like maybe more than just one checkup.
That's exactly right. It's essentially two audits rolled into one, working together. Specifically for public companies, it involves looking at the financial statements, sure, but also looking very closely at management's own assessment of their internal control over financial reporting. You'll often hear that called ICFR.
ICFR. So that's like the company's internal checks and balances.
Precisely. The safeguards they have in place to prevent or catch errors or even fraud in how they report their finances. So that second part is often just called the audit of internal control over financial reporting. The auditor's goal here, to give an official opinion, are those internal controls actually effective? And here's the crucial part. If there's even one single material weakness found in those controls,
Just one.
just one, if it's material, then the whole system of internal control can't be considered effective. It's a high bar. The aim is to get what we call reasonable assurance, that no material weaknesses exist as of a specific date, usually the year end.
Wow. Okay, one bad link breaks the chain. So who exactly needs this really thorough kind of audit? Is it every single company?
Good question. No, it's not everyone. There's a key difference between issuers. Those are the public companies listed on stock exchanges and non-issuers, like private companies. Issuers generally follow standards from the PCAOB, the Public Company Accounting Oversight Board. Non-issuers usually follow AICPA standards, specifically SAS 130. The rules themselves are actually, very similar in principle.
Okay, so public versus private. What about for the public ones?
Right. For the issuers, the Dodd-Frank Act really clarified things. Basically, this integrated audit, the one including the deep dive into ICFR, is mainly required for the larger public companies. We're talking large accelerated filers and accelerated filers. Think companies with significant market value, generally above $75 million in public float.
So the really big players.
Exactly, the ones with the most public impact. Smaller public companies, often defined as those with less than $100 million in annual revenue, are generally exempt from the ICFR audit requirement.
Got it. So primarily the big fish. For those companies that do need it, what are the specific jobs here? What does the auditor have to do, and what's management responsible for?
It's a very clear partnership, but with distinct roles. For the auditor, the ICFR audit and the financial statement audit have to be integrated. They can't really be done in isolation. This means planning and performing them together, using the exact same control criteria that management uses for its own evaluation. That alignment is key.
Yeah.
And the testing they do on controls, it needs to be robust enough to support both their opinion on internal control and their assessment of control risk for the financial statement audit itself. They're getting double duty from that testing.
Makes sense, efficiency-wise. And management side, particularly for those public companies under SOX.
Right, under Sarbanes-Oxley Section 404, management's duties are very specific. Their annual report must clearly state that they are responsible for setting up and maintaining adequate internal controls. And, crucially, it must include management's own assessment of how effective their ICFR was right as of the end of the latest fiscal year.
Okay, they have to put their own stake in the ground. What about for non-issuers, the private companies, if they opt for this?
Similar principles apply. Management still has to formally accept responsibility for ICFR being effective. They need to evaluate it using suitable criteria, maybe from the AICPA or a relevant regulatory body. And they need evidence to back up their assessment. This means, documenting their control objectives and the specific controls they have in place. And, like issuers, they must provide a written assessment to the auditor. It accompanies the auditor's report and needs to be as of the same date as the financial statements. It's a formal sign-off.
That written assessment sounds critical. What if?
No.
What if management just says no, they refuse to provide it? That seems like it would stop everything.
Oh, absolutely. It's a huge red flag. If management refuses to give that written assessment, auditors see it as a major scope limitation. Usually, the auditor's only real option is to withdraw from the engagement entirely.
Just walk away.
Pretty much. If withdrawal isn't possible for some legal reason, which is rare, they'd have to issue a disclaimer of opinion on the internal controls, basically saying, we couldn't form an opinion. And that would heavily impact the financial statement audit, too. It really shows how vital management's cooperation is.
Wow, okay. Serious stuff. So management cooperation is non-negotiable. Are there any other absolute must-haves that apply across the board, public or private?
Yes, there are. We call them written representations. Think of these as formal letters, signed by management, given directly to the auditor. In these letters, management formally acknowledges their responsibility for ICFR. They confirm they did their own assessment.
And didn't just rely on what the auditors found?
Exactly. They confirmed they didn't rely on the auditor's procedures for their assessment. They state their assessment as of that specific date. They also have to lay everything bare. Disclose all deficiencies they know about design flaws, operational issues, significant ones, material weaknesses, even unresolved past problems. Plus, describe any fraud they're aware of, especially anything involving senior management or causing a material misstatement. And finally, mention any significant changes to controls that happened after that, as of date, but before the audit report is issued.
And if they don't provide these letters?
Same outcome is refusing the assessment scope limitation. It usually leads to withdrawal or a disclaimer of opinion. It's management's final, formal confirmation of their role and findings.
Okay, so assuming everyone's cooperating and the paperwork's in order, how do auditors actually start planning this? It sounds incredibly complex. Where do they even begin mapping it out?
Planning is absolutely key. It's about developing an overall strategy, figuring out the scope, and how they'll perform the audit. They look at a whole range of things: industry factors, what's happening in the economy, any new laws, tech changes affecting the company. They use their past knowledge of the company, dig into its business operations. How complex is it? Has anything changed recently? They also look at how management, their evaluation. And then there's the crucial judgment call on materiality and risk.
Mm-hmm.
And this is important. They use the same level of materiality and the same risk assessment process for both the financial statement audit and the ICFR audit. They're completely linked.
Same benchmark for both. Makes sense.
Yeah, and areas with higher identified risk. Those get much more audit attention, naturally. They also consider the results of the fraud risk assessment from the financial statement audit.
Fraud. How does that fit in specifically with the ICFR audit?
It's directly integrated. Auditors pay special attention to the risks of management fraud and management override of controls. These are seen as inherently high-risk areas, so they'll focus testing on controls related to things like unusual transactions, significant last-minute journal entries, deals with related parties, and areas involving major management estimates or judgments. They're also thinking about controls that might reduce the incentive or opportunity for management to, cook the books, looking for weaknesses that could be exploited.
Right, looking for the pressure points. Now, with all this work, do auditors have to do every single piece of testing themselves? Or can they sometimes rely on work done by people inside the company?
They can use the work of others. This could be internal auditors, maybe other company staff, sometimes even third parties hired by the company. But, and this is a big but, those others must be judged to be sufficiently competent and objective. The auditor have to assess that first. And there's a sliding scale based on risk. The higher the risk associated with a specific control.
The less they rely on others.
Exactly. The less reliance the auditor places on their work. For very high-risk controls, the auditor might decide they need to do all the testing themselves, no matter how competent the internal team seems. It's about maintaining auditor independence and skepticism, especially where it matters most.
That risk-based approach makes sense. Okay, let's talk methodology. I've heard the term top-down approach. What does that actually mean when testing controls?
The top-down approach is really about being efficient and focusing efforts effectively. You start big picture. First, evaluate the overall risks at the financial statement level. What could go wrong that affects the financials as a whole? Then, you consider what are called entity-level controls. These are the broader controls that permeate the entire organization. And then, you drill down to focus on the specific accounts, disclosures and assertions, the individual line items and notes where there's a reasonable possibility of a material misstatement occurring.
So, start broad, then get specific. What are some examples of those entity-level controls?
They're foundational.
Right.
Think about the company's overall ethical tone and control environment, the tone at the top. Also, how management handles override risk, the company's own risk assessment process, any centralized processing systems, how they monitor results and other controls, the controls around period and financial reporting, that whole closing process.
Okay, the big overarching stuff.
Exactly. And these are really important because
Strong, effective entity-level controls can actually influence the amount of testing needed elsewhere. If the top-level controls are solid, it might reduce the need for quite as much detailed testing on lower-level transaction controls. It gives the auditor more confidence overall.
Interesting. So good controls at the top can mean less digging lower down. How do they then pick which specific accounts or transactions to focus on?
They identify the significant classes of transactions, account balances, and disclosures by looking at inherent risk factors. This means considering things like how big is the account? How inherently susceptible is it to misstatement just based on its nature? What's the volume and complexity of transactions running through it? Are there complex accounting rules involved? Is there exposure to potential losses? Any related party transactions? Significant changes from last year,
Lots of factors.
definitely. Higher risk in any of these areas means more audit attention. And one of the best ways to really understand the flow and identify where things might go wrong is by doing walkthroughs.
Walkthroughs.
Yeah, you literally trace a single transaction from its beginning, say, an order coming in all the way through the company's processes and systems until it ends up recorded in the financial statements. You inquire, observe, inspect documents along the way.
Like following the breadcrumbs.
Exactly. It helps pinpoint where controls are supposed to operate and where weaknesses might exist. Ultimately, auditors select the specific controls to test based on which ones are most critical for addressing the identified risks of material misstatement.
All right, the plan is set. The targets are identified. Now for the actual testing. How do they do it? What does testing a control look like in practice?
Well, the AICPA standards break ICFR down into components: the control environment, risk assessment, information and communication systems, monitoring activities, and the existing control activities themselves. The auditor's job is to verify that these components are not just present, but also functioning effectively and, crucially, that they're operating together in an integrated way. It's not just about individual controls in isolation.
Okay, so how do they check if they're functioning?
There are really two main aspects they test. First is design effectiveness. The
Yeah.
question here is, if this control is operated perfectly, exactly as it's written down or designed, would it actually prevent or detect and correct a material misstatement?
So is the blueprint sound?
Precisely. They often test this using those walkthroughs we mentioned, combining asking questions, inquiry, watching the process, observation, and looking at documents,
Yeah.
inspection. The second aspect is operating effectiveness, this asks. Is the control actually working as intended in the real world, day to day? And are the people running the control qualified and capable?
So does it work in practice, not just on paper?
Exactly. And testing this requires more direct evidence. Inquiry is part of it, but it's never enough on its own. Auditors need to inspect relevant documents, directly observe the control being performed, sometimes recalculate figures, or even reperform the control themselves to verify it works.
Got it. Inquiry alone isn't proof.
Definitely not for operating effectiveness. And some key principles guide this testing. For controls linked to higher risks of failure, auditors need to gather more evidence. Their final opinion is on the overall effectiveness of ICFR, not on every single control being perfect. An individual control might have a hiccup now and then, a deviation, but still be considered effective as part of the whole system. Timing matters too. Testing over a longer period gives better evidence than just a snapshot. Tests done closer to the year-end date, as of date, are generally stronger. Auditors use judgment, consider past audit knowledge, and often introduce unpredictability in their testing, timing, and selection.
Keep them guessing a bit.
Right. Now, what about companies that outsource things, like payroll?
Good point. If another company handles it, are their controls part of the audit?
Yes, they are. If an entity uses a service organization, say for payroll processing or IT hosting, that service organization's controls are effectively part of the entity's own ICFR. So the auditor needs to understand those controls and get evidence that they're working effectively. They can do this in a few ways. Get a specific report from the service organization's auditor, often called a SOC report. Test the company's own controls over how they monitor the service organization. Or, in some cases, go and test controls directly at the service organization itself.
So they have options. Is there anything specific about reporting this?
Yes, an important detail. The company's auditor should not reference the service auditor's report in their own audit report on internal control. They need to form their own opinion based on the evidence they gather.
Okay, what about automated controls? Things done by computers.
Ah, yes, benchmarking. This can be an efficiency tool. Automated controls, by nature, are less prone to simple human error than manual ones.
So if the underlying general IT controls, things like controls over program changes, access security, system development, are tested and found to be effective, and if a specific automated application control hasn't changed since it was last tested,
They might not need to retest it every single year.
correct, they might be able to benchmark it. This is generally for lower risk controls. But the auditor absolutely must perform procedures each year to verify that the control hasn't actually changed. They can't just assume.
Makes sense. Gotta check that nothing's been tweaked. Okay, so testing happens, evidence is gathered. What if they find problems? What happens when controls aren't working as expected?
When auditors find deficiencies, the next step is to evaluate how serious they are. They need to classify them as either just deficiencies, more serious, significant deficiencies, or the most critical category, material weaknesses. That classification depends on two things. First, the potential magnitude of misstatement that could result from the failure. How big could the error be? Second, the likelihood is there a reasonable possibility that the control, or combination of controls, will fail to prevent or detect and correct a material misstatement in the financials.
So it's about potential impact and likelihood, not just whether an error actually happened.
Exactly. That's a critical point. There are some strong indicators that often point towards a material weakness. Things like discovering fraud involving senior management, or if the company has to restate previously issued financial statements to fix a material error, or if the auditor finds a material misstatement that the company's own internal controls completely missed. That's a big one. Or if there's evidence of ineffective oversight by the board or audit committee. And here's something that often surprises people. A control deficiency can be judged a material weakness even if no actual financial misstatement occurred.
Really? Even if the numbers were okay in the end?
Yes, it's about the risk. The weakness in the system is so severe that there's a reasonable possibility a material misstatement could occur even if it didn't happen this time. The potential is the problem.
So it's about the flaw in the safety net itself.
Precisely. Now, sometimes other controls might pick up the slack. We call these compensating controls. If auditors test these and find they effectively mitigate the risk from the weak control, it might prevent the deficiency from being classified as a material weakness.
Okay, so there can be mitigating factors. All this testing, evaluation, it all leads up to the auditor's final opinion, right? How do they pull it all together?
They form their opinion on the effectiveness of ICFR by looking at all the evidence they've gathered. That includes everything from the specific ICFR tests and any relevant findings from the financial statement audit work. It's a holistic view. They also carefully review management's own report on internal control. Remember that report we talked about?
The one management has to provide.
Right. It needs to state their responsibility, identify the framework they used, like COSO, include their assessment as of year end, and importantly, describe any material weaknesses they identified. Now here's where auditor reporting gets really important for transparency. If the auditor concludes that management's report is incomplete, maybe it omits a material weakness the auditor found, or it's just not presented properly.
My auditor has to call it out.
Yes. The auditor's own report must describe the issue and specifically disclose any material weaknesses that management failed to include in their report. It ensures users of the report get the full picture. And again, if management just refuses to provide their report at all, auditor withdraws. Also, if management includes extra stuff in their report, maybe a cost-benefit analysis of fixing a weakness, the auditor reads it to check for inconsistencies with their findings, but they specifically disclaim an opinion on that extra information. Their opinion is strictly on ICFR effectiveness itself.
Okay, clear boundaries. Now let's really nail down something that can be confusing, especially for non-issuers. The difference between this ICFR audit and the regular financial statement audit. How do they compare and contrast?
It's a great point to clarify. They're definitely distinct, even though they're integrated. Think about the core purpose. For an ICFR audit, especially under AICPA standards for non-issuers engaging for one, the purpose is squarely to express an opinion on the effectiveness of those internal controls at a specific point in time, usually year-end. The financial statement audit's purpose, while it involves understanding controls, is ultimately about expressing an opinion on whether the financial statements are fairly presented over a period. Considering controls helps plan the nature, timing, and extent of financial statement tests.
Point in time versus over a period? Okay.
Right, and that leads to differences in the relevant period. ICFR opinion, snapshot at year-end. Financial statement opinion covers the entire year, usually. The extent of testing also differs. An ICFR audit requires the auditor to get evidence about control effectiveness over all relevant assertions for all significant accounts and disclosures. It's broad. For a financial statement audit, The auditor doesn't necessarily have to test controls for all assertions. If they assess control risk as high, or if testing controls isn't efficient, they might rely more heavily on substantive testing, directly testing the account balances.
So, potentially less control testing in a pure financial audit.
Potentially, yes, depending on the audit strategy. And finally, communication of deficiencies works differently. In an ICFR audit engagement, significant deficiencies and material weaknesses must be communicated in writing by the report release date, and that communication is not restricted use. It can be shared. In a financial statement-only audit, that communication usually happens within 60 days after the report release date, and crucially, it includes restricted use language. It's generally intended only for management and the board.
Different timing, different audience. Got it. But despite these differences, they're still deeply connected, aren't they?
Absolutely inseparable in practice, especially when performed as an integrated audit. The findings constantly flow back and forth. Results from tests done for the financial statement audit, they feed into the ICFR opinion. Results from the specific ICFR control tests, they inform the auditor's control risk assessment and testing strategy for the financial statement audit. If the auditor finds a weakness during the ICFR work, that directly tells them they need to do more substantive testing on the related financial statement accounts. The nature, timing, and extent of those tests will change.
And the other way around.
Yep. If, during the financial statement audit, they find misstatements, that raises serious questions about whether the controls were truly effective, impacting the ICFR opinion. It's a constant feedback loop. One important nuance, though. Just because the auditor doesn't find any misstatements during the financial statement audit, that doesn't automatically prove the controls are effective.
Ah, okay. Lack of detected errors isn't proof of strong controls.
Right. Controls could still be weak, maybe the sample missed it, or the potential error just didn't materialize this year. But finding misstatements is strong evidence that controls may not be effective.
Well, there we have it. We've really gone deep behind the curtain on integrated audits. It's far more than just checking the math. It's about the integrity of the entire system producing the numbers. The level of detail, the scrutiny, the judgment involved, it really underscores how much goes into ensuring these financial safeguards are robust.
It really does. And maybe something for you to think about. Given this intense level of scrutiny and the responsibility auditors carry in an integrated audit, what does that truly imply for corporate transparency, for investor trust, and maybe even for the stability of our financial markets as a whole? How does understanding these intricate underlying processes perhaps change your perspective on the real value behind a company's reported financials?
That's definitely some serious food for thought. Thanks for joining us on another deep dive.